Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our market recap here at Core Finance today. And my special guest is Mike Ingram, Strategist at BGC Partners. Now, Mike, I guess I have the question. The last time we talked, it looked like the Federal Reserve, as slowly as they're moving, could be the only central bank in the world to raise rates. And yesterday we had, I think, a very pleasant surprise for the Bank of Canada.
Yeah, I don't know. I mean, the whole central banking firmament is looking quite wobbly, isn't it? I mean, I think the last time we spoke, I opined that the Fed, by continuing to reiterate its adherence to its quite aggressive dot plot, was perhaps pursuing a sort of a financial stability leg to its mandate. And of course, subsequently, we've had various statements from people within the Fed, including Janet Yellen herself, talking about asset prices and worrying that there might be some bit of froth.
How can you say that? Just because the Dow closed at an all-time high yesterday on very heavy volume? What do you mean?
Yeah,
asset
nothing to support that other than the facts. But I mean, but in a testimony yesterday, again, she went wobbly on inflation. I mean, we keep hearing from these central banks they're data driven. We can see which way the incoming data is going, and we can see what market expectations are for some of these data sets in inflation, for instance, going forward, and to form a break even in inflation swaps. And if that continues to say, well, we're just not seeing this inflationary environment, then
there's two reports I read this morning. How do you become in 24 hours a Dovish Hawk? And that's what they seem to indicate. And yet, is what you were talking about.
Yeah.
Again, I was more interested in the Fed beige book last night, okay,
yes,
which showed 11 of the 13 districts showing, maybe it's overly, a very, very severe shortage of qualified people, okay?
Yeah.
Bricklayers, IT, et cetera, et cetera, et cetera. Now, at one point, since we're all running out of an available labor pool, we should start seeing some kind of wage price pressures in the States, wouldn't you think?
You would have thought. I mean, if as you say, the beige book, and employers themselves have been talking about this. It's reflected in things like job openings and so forth. There are clearly bottlenecks in the labour supply, and one would have thought, and of course the Fed has been expecting that to be reflected in wages. It hasn't happened yet. I suppose the worry is that to some extent, we have this period of calm, and then all of a sudden it goes parabolic, and and at that point, of course, the Fed goes, well, actually, we're even more obviously behind the curve.
Well, let's look at again the first chart again, as we saw right now, okay, with the Federal Reserve, their last meeting on the 14th. 26, again, a meaningless meeting because there's no press conference, okay? Yeah. As we saw going into Janet Yellen's comments yesterday, and basically it'll be the same comments today, whether the Q&A is any different. The market still is basically 50-50 for a rate hike by the end of the year, only 14% for September. So my feeling on the 20th with the press conference, I think they will initiate or lay the groundwork for their only $4 trillion reduction of their balance sheet. And probably, I still feel, that we will get another rate hike on the 13th of December.
Yeah, I think you're spot on, Bill, on that one.
And, I guess my feeling is after the Bank of Canada yesterday, at least the way Euro's going, I don't see them moving the European Central Bank in July, but August to September, would you see a possible move then?
Well, I think, in rates, no, but I mean, and certainly again, the issue there is tapering, isn't it?
Okay.
Of their asset purchase program, which is otherwise due to expire at the end of this year. So I think if there is going to be a taper, and let's be honest, for technical reasons, they're essentially going to run out of bunds, for instance, to buy. Although I was quite interested by the comments of Mr. Smiley, Mr. Wolfgang Schäuble, the German finance minister, who was talking about, good Lord, fiscal expansion in Germany of over 0.5% of GDP. And, I have to wonder what's going on there. Is this to do with the political cycle? Is this to, basically giving the ECB a few more bunds to buy?
Knowing that we have the German election on the 24th, again, July and August, doing nothing by the ECB, so they make sure they stay apolitical here.
Yeah.
So let's see what the next chart tells us here. And you've got, as you can see right now, all right, to our new viewers, What do this mean?
What did this mean? Well, it mean, Bill. So the bottom line, the green line we'll start there. So this is basically the effective Fed funds rate. So it's the market-based cost of short-term funding in the US. And there you can see the one rate hike that we got in from the Fed in 2016 in December. That's that first kick up. And you can also see the subsequent 2 rate hikes that we had in March and June of this year. Now, the blue and red lines are basically what a derivative contract is, a Fed fund future. It's what the market thinks that Fed funds rate, the effective rate, is going to be at those dates. So the blue line is January 2018, red line is January 2019. And if you look across that chart, it's basically, as you said earlier, it's a coin flip as to whether we're going to get another rate hike, that third rate hike that the Fed dot plot says they're going to put in place by the end of this year. It's just over 50% at the moment. And for the following year, the market's discounted 1 more quarter point hike, not 3, which is what the Fed's going at. And by the way, if we were to push this out to a January 2020 future, again, the market's only expecting 1 rate hike, not 3 in the 2019.
Okay, now, we talked about the political situation with German election on the 24th of September.
Yeah.
Janet Yellen's contract expires at midnight on the 31st of January 2018. How do you think, first of all, do you think she wants another 4-year term?
Well, she's going to be beaten up like a pinata if she's...
Yes.
I think it was obvious that Ben Bernanke wanted to go.
Yes.
He looked as though he'd had enough in watching her testimony to the House yesterday. She looked like she'd had enough already.
Yes.
So I think, look, Trump's not going to renew a mandate anyway.
No, not at all.
So yeah, I think she's gone. I think Stanley Fischer is gone. Obviously, you've got 3 governor seats also vacant at the moment. Dan Turullo going in April. So I guess the question becomes is who takes her place, and what kind of Fed are we looking at? Because it's all very well for us to pass the guidance at the moment, but potentially we could be looking at a completely different FOMC by this time next year. And it's interesting to note that the 3 people actually, which are being mooted to replace Janet Yellen next year. Gary Kern, who's probably dovish, although again he's not an economist for starters.
No, not at
all. Kevin Warsh, who was a former Fed governor, 2006 through 11, I believe, and he's hawkish. He's penned some very hawkish articles, and also, John Taylor of the famous Taylor Rule was by definition hawkish. So that's quite an eclectic bunch, and it's interesting to note that we had yesterday a very big volatility trade put on in the 10-year futures market called a strangle, buying puts and calls, expecting volatility in the 10-year. Right now, volatility across virtually every single asset class you can look at has cratered in recent months. It's ticked up a little bit over the last 2 weeks or so, but on any historic basis, pretty much all asset masks are becalmed. Interesting to see somebody putting real money out there expecting a pickup in vol. Thus far this year, it's been a losing trade.
One of the points you just mentioned about John Taylor with the Taylor Rule.
Yes.
The people that have been sort of anti-Janet Yellen, because her husband did win the Nobel Prize. She was, again, an economist. People saying a lot of, whether it be the Phillips curve, the Taylor Rule, et cetera, we're in the new normal. So therefore, a lot of these may be rules and regulations. And I guess my feeling is, I would like to see a market participant. Maybe I'm sorry, I'm a big fan of Greenspan. I mean, Greenspan was in the market for years, before he became the Fed governor. And I guess my feeling is, with the 3 names you mentioned, knowing Donald Trump does things in a different way. I mean, would it surprise you if, say, the last quarter of this year, maybe he met all 3 of them, or even a 3rd, 4th, 5th, 6th person, and sort of sat down and said, okay, guys, give me your idea of how you would run the Fed for the next 4 years.
I mean, also speaking as a non-economist, but I mean, I would actually like there to be a real debate within central banks generally. I mean, one of the criticisms which the Fed, I think, has rightly drawn is that it's just too closeted. And it's a lot of very well-established PhDs or basically reaffirming each other's. Yes, there's a spread of opinion, but I think you don't get anybody really coming up with anything terribly new. There's a lot of navel gazing going on, and I think felt a fresh perspective from people within the industry, maybe a bit closer to the real economy, people who had actually got their hands dirty at one point in time. Might be a good idea.
Here, what we got here. Now, again, I love this,
Well, yeah.
failure to inflate. Now, this is something that we were talking about before, okay?
Yeah.
Because you and I remember, for the simple fact is, it was just this time last week, remember, it's been 10 years before the Bank of England raised rates to 5 3/4, when we had inflation in maybe these people won't understand it, it's called double digits. It would be 10 points rather than points. Such
Point 10.
And I mean, a simple. But do you look at the simple fact is, with the global economy having almost every country in the world except Burkina Faso and maybe 4 others being developed nations,
Yes.
you're not going to have the inflation pressures that you see with like OPEC cutting out oil in 73, 74, and 78, 79, when we had the pizza wars with wheat and stuff like that. I mean, inflation, is something that rampant inflation, to me, is going to become a non-existent word.
Yeah, I mean, I think there are reasons to suggest that inflation structurally is going to be lower. I mean, you've got, the internet is making price discovery much more much easier. That's driving down prices. Demographics,
Yes.
are causing people to go into relatively long-term and low-risk. So bonds, for instance, asset liability matching. Those are very crowded trades. I think that's one of the reasons why you've got the so-called term premium is actually negative.
Now, you mentioned about demographics.
Yeah.
Again, not so much with our generation, but the next generations, both here in the U.S. Pension. At our age started at 60. I mean, now if these people are going to be living to 100 and 125, pension may not start till 80. So you may see people working 65, 70, 75. If it's the gig economy or not, it's something to just supplement, their minimum income.
I think it's going to have to happen, because if you look at the sort of long-term finances of virtually every major developed nation, we're insolvent.
Yes.
We're really insolvent. And of course, I'd have to say, when Bismarck introduced public pensions in the 1880s, essentially it was where people were not expected to live long enough to actually draw them.
Let's see what the next chart you've got.
I just wanted to point out, in addition to the interest rate debate, there is the prospect also of the Fed shrinking its $4.5 trillion balance sheet. So we're going from QE to QT. Now, a lot of people have said, well, we've already had quantitative tightening because of the rundown in FX reserves in emerging markets, notably China, since 2015. But I think that's a bit of a misnomer, because basically, they're liquidating the reserve assets. That dollar liquidity is still going somewhere. It's still within the system. But this is an absolute shrinkage of base money. Anyway, if it was quantitative easing on the way up, this must be quantitative tightening on the way down. And actually, it was interesting to sort of go back to something I said a little bit earlier. I think the fact that they are keen to shrink the balance sheet also in an environment where they're still being, still relatively hawkish, despite Yellen's wobbles yesterday in terms of where they want the dot plot to go. Again, this plays into the idea that then they think that the Fed's balance sheet has probably, over the longer term, caused some significant asset significant asset misallocation in terms of where resources are being placed in the global economy. I mean, again, going back to something that you said in terms of the Fed being behind the curve, I do believe ultimately the Fed's being behind the curve. Maybe not for the reason that most people would think that they are, but I think that you've had too loose monetary policy globally for too long. I think that's crowded out. So you've had a bad investment that's crowded out good investment. I think it's one of the reasons you've seen productivity crater, and this, of course, is going to damage the long-term health of the global economy.
Mike, we've got about a minute left. Brief thoughts on, if you're an investor, bonds, stocks, the dollar, where do you go?
I think short term you continue to melt up. I think what we're seeing is a melt up, basically. The thing that does worry me is that, again, you've got this yawning gap between what the Fed's going to say. Exactly, yawning. Well, that's a good funny. Yawning gap between what the market's expecting from the Fed, which is not very much, and what the Fed says it's going to do. And I I still think that of course, that can be resolved ultimately in one of two ways. But surely, that no matter which direction it's resolved in, that's got to generate a certain amount of volatility. Now, if you've been long vol going into this year, you'd have had you actually handed to you.
Yeah.
You'd have lost a lot of money. That's the problem. Nobody wants to put those trades in because you're up against the Greenspan, Bernanke, Yellen put. But I've got to feel you are got a major volatility event, and I fail to believe we're not going to see that before the end of this year.
So basically, we could probably just watch Wimbledon, U.S. tennis, the Open. Watch the sports television.
I think we can roll with it over the summer. I wouldn't be necessarily. They don't call it the fall for no reason.
So, Mike, thank you very much for your comments, and hopefully we will see you before September.
I look forward to that.
Thank you very much.